Hi, everyone. It's Rick Bensignor, and welcome to this week's In the Know Trader show on StockCharts.com. Well, markets again pretty flat, and the S&P continues to hover around the 3,000 level. Can't get much past it on the upside, and over the last 2 weeks, we really don't appreciably sell down. So we're kind of stuck here as news flow continues to keep us bound to this level. We're not getting enough bullish news to break out to new highs, and things just aren't so bad to really get people significantly selling. So let's take a look at what we're going to talk about today. And we'll start off as we normally do. We'll take a look at the macro sector performance week over week to see what's changing in the market, if anything. We'll look at the S&P more in depth with our chart. And this week I thought it made sense to go back and review the sequential model. This is clearly one of the key models we use that helps differentiate the type product that In the Know Trader is from other technical services. It's much more geared for showing our readers how and when institutions trade in the market. This is one of their preferred models too. And because we're constantly getting new listeners, and this is often at the forefront of how we interpret charts, I figured it makes sense to review the model again for those who have seen it before but want a little more clarification, and for also those of you who are new to the podcast, or let's say today's show, and haven't had a chance to watch some of the previous ones that we've done on this show. That'll be the bulk of what we do today. As a reminder, if you're in the Philadelphia, Pennsylvania area this Friday, I will be speaking at the Money Show there. My time slot is from 1:40 to 2:30 in the afternoon. They're doing an entire track for financial advisors. So if you are there, certainly come by, and that's when I'll be speaking. And let's take a look at sector performance. So we've got on the far left 2 weeks ago, leading into last Wednesday, and then this past week as of last night's close. So these are all year to date. These are performance charts from StockCharts.com. You have multiple ways that you can display these, but I like them looking at them in bars. It's kind of easy to see what's moved week over week, and I've highlighted those sectors with a red dot so we can see all the way on the far right real estate. So if it's moved more than 1% in performance week over week, I tend to highlight it so you can see that real estate's come off. Look at where it was 2 weeks ago, up 11.05%. Now it's up only about 9% on the year, so they've come in. Healthcare is still a troubled sector, down 12.28% versus what the S&P has done. Again, year to date, that's picked up more downside versus the 11.4 from 2 weeks ago. And then look at materials, down to 2.37. They were down 3.7, so they've actually picked up about 1.3 or so of movement versus the S&P. So that's a gainer in there over the last week over week. And then lastly, industrials are up just about 3.1%. They were up 4.26, so they've gotten hit. So usually also most weeks we do see more of the 11 sectors with weekly changes of 1% or more. So it's also interesting to me to see that there's only 4, which shows you in a certain way that not a heck of a lot has gone on in the past week. And that pretty much matches what I first said, that the S&P is hanging out near 3,000. Obviously, there's always some sector rotation going on, but we haven't had big moves over the last week, and that's pretty much because the market's just hanging out here without a lot of information and news flow coming to materially change what's gone on. Just sometimes we run out of time at the end of the show. So in order to contact me, the best way to get to me is rick@inthenotrader.com. I answer my emails pretty darn quickly. Check out our website, also inthenotrader.com. We have lots of information on there, a ton of videos and recordings and times that have been on TV and podcasts and all different type of things on there to listen to, as well as all the information there is about subscribing to In the Know Trader, etc. So now let's switch to our charts. And as many of you know, I typically use this charting platform simply because it allows me access to the sequential model and some of the other, let's say, Tom DeMark models that I use and incorporate into my market analysis. So here's the S&P. This is real time. You can see it's trading at 29.94 as we talk. So since breaking out in July to the highest highs, the all-time highs that we've seen, we did have a sequential 13 in here. We pulled back. We made a slightly higher high to what is now the all-time high of 3,028. And then, of course, we had the August decline that had us in a trading range for pretty much all of August that, again, broke out to the upside in September. There's a gap up here in early September. In fact, there's two unfilled gaps. Pretty much from September 3rd to September 4th, and then from the 4th to the 5th. These gaps have not been filled yet, so those are still potential gaps to fill on the downside should the market pull back. You can see that we're stalling up against, again, multiple price targets that have been here. This kind of dark brown line here is the risk level to this 13. In other words, getting above this level of 3,026, or actually 3,026 properly suggests we'll go higher. We have yet to do that. There's a propulsion target in here. So this light blue line here with the triangles is at a value of 3,033. That is a level that's been in place since the low was made in June. And this model, different than the 13 model, it's called propulsion, says that if we had gotten through 2881 properly, which it did, we would get, there's enough thrust, kind of the physics of the market suggests that if we get through there, we can target 3,033. Obviously, we got to 3,028, just 5 points away from that as the all-time high. And then just above there is something called a trend factor. Again, these were all Tom DeMark models. The trend factor measures to 3,042. That is measured off of the lowest low we saw in August, and that is essentially a 5.56% increase from there, giving the first target with that particular model. So we've got a cluster of resistance in the S&P in and around the 3,030 level. So far, we have a potential double top. We haven't sold off enough yet to define this as a top, because if tomorrow we shot up 30 points, we'd be right through it and there would be no double top. But for the time being, we're certainly stalling against what was the all-time highs. Of significance to that, and we'll get a little more in depth into this in the balance of the show, is this setup 9 count, which is part of the sequential model, and the fact that we got a setup 9 count at a price that was lower than this 13 count had me tell institutional clients to lighten up tactical longs here. So we're still long, but just a very minor tactical long. We're also long in long-short portfolios, as many of you know. There's a fair chunk of all percent of hedge funds that do what are called long-short books. And what they do is this way: they take market risk, or a significant amount of market risk, out of the equation. They have stocks that they're long. They have somewhat comparable peer-type stocks that they're short. Again, we've given examples before. If you wanted to look at, Home Depot versus Lowe's, and let's say you were long one of them and short the other, you've taken market risk out of the equation, and it's really now, have you done the analysis correctly that, let's say, if it was long Home Depot and short Lowe's, all you're looking for is Home Depot to outperform Lowe's over time. That's some people would say that you could do, Target versus Kohl's, and things like that, restaurants that are similar, etc. So many hedge funds run their portfolios this way by doing a combination of mostly fundamental analysis, some technical analysis to determine which of two particular stocks will do better than the other, and they make those their longs. They put the other side as the short, and they run full portfolios like that, just simply being long versus short to again take the direction of the stock market out of the equation and just to have one company's results versus another. So in my institutional report, which is called Bensignor Investment Strategies, we run two portfolios: a tactical one, which is basically short-term trading of the direction of the S&P at any given time, and then also how institutions would run long-short books with what percent. They don't always run a matched book in the sense of the weighting. They may be they're long one name versus short another, but if they're really bullish the market or bullish that one name more so, they may be long, let's say 1.5 times the long versus what they're short. So we'll also give them a clue as to what the bias is that I have kind of for running long short books. So right now we're 50% long at a maximum 200% long. So 0% bias means I'm completely neutral the market. 200% long would mean that I'm very, very bullish the market. So right now we're 50% bullish bias for long short books and 25% bullish bias for just tactical books. So we clearly still have a long bias, and when and if we break out to the upside, we'll add longs exposure on both sides, because next upside targets, once we were to get above 3,064, which is a level that comes from the weekly chart, the next targets are above 3,100. So we'll up the bullish bias if that happens. On the downside, if we get daily closes, in fact, here, let me see. Yeah, so I think I'm using both a combination of 29.11 and 28.88. Getting properly under these levels takes all the bullish bias away, and then I think we probably have much more significant problems. So somewhere between roughly 29.11 and 28.88 is the theoretical, we'll say, sell stop to bullish bias on my part, and that will get me more bearish. So that's a look at the S&P. So we've got about 15 minutes left, which is perfect, because I want to take a look at and show you the sequential model. So I've picked. This happens to be December silver. So this is silver futures traded on COMEX. And it actually goes all the way back to the beginning of this year. So what we're going to do is ultimately we're going to scroll through this whole chart to get us up to present time. But I want to walk you through, it just happened to be something I was looking at earlier this morning. And I want to walk you through the key elements of the sequential model. So it all starts off with the model's intent is to identify potential turning points in the market at the time of the actual turn, which often can be very different than what other general indicators that most technicians look at will tell you. So for instance, let's look at, if we think of a moving average, in and of itself, a moving average on its own isn't going to be able to typically provide you where a high or low is by looking at the slope of the moving average. If it's upward pointing, all you know is that you have a long-term trend in that direction, or even a short-term trend, but it's going in the direction. And if a market peaks It's going to take some time for that moving average to actually peak itself and roll over. And generally, let's say most people wouldn't be using one particular moving average. You'd often need two to filter the moving average so that one crosses underneath the other. So, whether it's a 50-day crossing a 200-day, that's never going to come at the top of a move to help you sell right near the high, or it's never going to come at the bottom of the move to help you buy the low. That would be extremely rare. In fact, it's virtually impossible for that to happen because of the lagging nature of moving averages. So what this model attempts to do is to identify potential turning points in the market well before they're obvious to the marketplace. And it does so in a two-step fashion. First, what it says, and again, I give all the credit to Tom DeMark of Market Analytics. He invented this model back in the 1970s. It is just minimally tweaked over the over 40 years that it's been used by the institutional community. So there have been minor tweaks, but not significant enough to get into the details of that in today's conversation. So I want to give you the basics here of what he saw in the market. And mind you, he did this in the early 1970s before computers could plot this itself. So he saw this in his head. He figured this out himself. So kudos to him for being able to have spot this type pattern that was not about drawing lines. It was actually, looking at price bars movement versus each other to come up with the pattern that he saw. So here it is. The first point to this model is defining what's called a setup move. And in the case of a market moving upwards, so let me highlight it here. Oops, sorry. Let's, I want to take this away. Come on, cooperate with me. You're not going to, are you? Okay, we'll forget about that line. Let's go to a rectangle. So we're going to first look at this section here. Why is it different than other price movement? Well, it's because for 9 consecutive price bars, and in this case, it's a daily chart, it indicates that each one of the closes is above the close from 4 price bars prior. So if we go to bar 1, we count back 1, 2, 3, 4 price bars. This bar happened to be above the close from 4 bars prior. In fact, here, let's do this. This bar that I'm highlighting now was also, if you count back 1, 2, 3, 4, it was above the price bars, the close of 4 bars prior. So in real time, this had a number 1 on top of it. But then the next day, we count back 1, 2, 3, 4. This price bar was beneath the close of 4 days prior. So then the 1 dropped off on the screen in real time from being above this price bar to being beneath this price bar. The next day, we count again. We look at that day's close versus 4 prior, and then it flips again, and this gets you a 1 above. So in real time, the stuff is constantly flipping. But then the next day, you look at where the close is relative to the close 4 bars prior, and you say, okay, this is also above so this gets a 2. And this wouldn't be bar 3 if bar 3's close was all the way down here and less than the close from 4 bars prior. But it was above the close from 4 bars prior, so it gets bar 3 and bar 4 and 5, 6, 7, 8, 9. And when you get 9 bars in a row, in this case moving upward, that the close is above the close from 4 days prior. And again, I'm looking at close to close on a daily chart, so each one of these is a day. If you look at a weekly chart, you be comparing the close of the week versus the close of 4 weeks prior. This model can be done on any time frame. So you make a 9 count. And what Tom said was a market needs to minimally move 9 consecutive price bars, close above the close from 4 bars prior, or, I'm going to take this, remove this, or 9 consecutive bars that the close is less than the close from 4 bars prior. It needs to move that amount at a minimum to say that the market's moved, it meets the basic or the minimum requirement of what potentially means there's more trend coming. So 9 counts trigger the second part of the model, which we'll get to. But often 9 counts are all a market goes in one direction before it turns and goes in the opposite direction. So sometimes we'll trade off of 9 counts, not because it's defined as being the actual turning point, the way this model ultimately will get to, and we'll talk about what defines the suggested end of a move. But over time, I've used this model now for over 30 years, and clearly to me, 9 counts alone often give me some sense that a market's moved just enough in one direction, but not enough to keep going, that you get a short-term turn in the market. So you can see here that just again, going back to earlier this year, there's a period of time that we see an up move that essentially peaks on the 9 count. I mean, the actual count peaked on bar 8, but even though bar 9's close, and this is important to realize, the close doesn't have to be higher than the day before. It just needs to be higher than 4 bars ago. Well, 9's going to be a 9 if it's above the close of 5. And same thing on the downside. If any time along the way you don't close above the close from 4 bars back, the numbers drop off in the upward direction, and it'll show up underneath the price bar on the downside, beneath the price bar. And when I see this, it tells me that any day's close is less than the close from 4 bars before. And I know to look, 9 counts often give me a potential change. So you had a couple moves here that suggested the 9 counts are near-term turning points. But the 9 count is only the beginning to what ultimately looks for the end of the trend, and that's called the countdown portion. And the countdown portion is what we'll see here in red numbers. So what's that? Well, if minimally I need to see 9 consecutive price bars that the close is less than the close from 4 bars prior to indicate that there might still be more downtrend, then the software is going to continue looking for the ending to this count, the end of the trend that started with this count. Now, the rules change for the red count, the countdown portion. Once I do a 9 count, the software is going to look for, so after, let's say, 9 consecutive price bars that the close is less than the close from 4 bars prior, it's going to look for each time that a close is less than the low from 2 bars prior. All right, so we're switching from relating the close to the close 4 bars earlier. In this case, we're now looking for closes that are less than the low 2 bars earlier. Now, it happens that on bar 9, not only did it close less than the close from 4 bars earlier, but it also closed less than the low from 2 bars earlier, and therefore it also started the countdown. What happened the next day? Was this close less than the low from 2 bars earlier? It certainly wasn't. So it does not have a number underneath it because it didn't meet the requirement. It also does not kill the countdown because it does not need to have consecutive bars. Now, ultimately, we're looking for 13 bars that close less than the low from 2 bars earlier to finish this trend that started with the 9 count. So again, you'll see gaps in time because none of these closes were less than the low from 2 bars earlier. And we haven't rallied enough in order to cancel this model still looking for a downtrend to occur. So how would this stop looking to ultimately find 13 bars of closes less than the low? We would have to trade an entire we would have to trade an entire bar above what's going on here? Not good. We would have to trade an entire bar where the high, the entire range of the bar is above the highest high of all the bars that make up the 9 count. So in this case, it's bar 1. So silver would have to trade above 16.365 and have a low, not just trade above, but actually have the low of the day higher than the highest high that made up this 9 down count. So that would cancel this looking for a bottom to the beginning of this trend lower. So ultimately, we get to a 13. And I have big numbers here so I don't miss where the 13s are. So this bar here closed less than the low from 2 bars back. This now says, it's suggesting that this downtrend that started all the way on bar 1 is likely complete. And at a minimum, what Mark said here is that this would indicate a very high risk time to be a seller. Now, as time goes on, this actually proved to be a very good indication of the end of the downtrend because silver bottomed, did a 9 up. You see a pause after the 9 up, which you often get, but ultimately, I want you to notice that now we're up to September of this year, the day that silver made the highest high to this entire move is on a 13 count and followed just 1 bar later by another 9 count, which we know often itself could be a near-term turn. And yet it came kind of in conjunction with the 13, and silver fell from what got up to 1975 down to 1750, $1.75. That was just mathematically, that's about a 8-9% pullback in a matter of 2 weeks. That is huge. So this very aptly identified where you had a very high risk time to be a buyer in silver, and those who are aggressive, well, if it's a very high risk time to be a buyer, many of them, many players will also interpret that to be a shorting opportunity. So that's kind of a refresh of what this model is and why we use it so often. So even as we're running out of time now, but I want to show you, here's, for instance, a 60-minute chart of crude oil. Tops here a few days ago. This huge up move was last Sunday on the Iran bombing, all right? But even here, 13 bottoms since then, and also gave you a clue that things are potentially getting closer to a near-term bottom. So that's it for this week. I'm Rick Bensignor. Tune in next week again for the In the Know Trader show. Bye-bye.